My name is Maximilian Caldwell. I am the VP of Finance at GAMCO Investors. I'm going to speak on the impact that the accounting rules have had on the current challenges in the banking industry. The current accounting rules have roots going back to the savings and loan crisis in the 1980s, where there was a similar rise in inflation and interest rates, which caused stress in the banking system. In the aftermath of the crisis, the Financial Accounting Standards Board issued Statement Number 115 in 1993, which bifurcated investments into three categories: held to maturity, trading, and available for sale. Held to maturity securities are those debt securities that the bank has the positive intent and ability to hold to maturity and are reported at amortized cost. Trading securities are those debt and equity securities that are bought and held principally for the purpose of selling them in the near term and are reported at fair value. Debt and equity securities not classified as either held to maturity securities or trading securities are classified as available for sale securities and are also reported at fair value. As both trading securities and available for sale securities are reported at fair value, the changes in the market value of these securities directly affect banks' tangible book value reported quarterly, whereas the changes in the market value of held to maturity securities do not. Further guidance on fair value was issued in 2006, termed Statement of Financial Accounting Standards Number 157, or FAS 157 for short. Now codified under Accounting Standards Code Topic 820, FAS 157 introduced a classification system with levels 1, 2, and 3. Each level is distinguished by how easily assets can be accurately valued, with level 1 assets being the easiest with readily available market prices, and level 3 assets being the hardest with asset values based on models and unobservable inputs because these assets are not actively traded. This guidance has improved visibility into asset valuations with a focus on exit price. However, it did not impact the valuation of held to maturity securities, which are still not marked to market. When held until maturity and not impaired, these securities could be viewed to be correctly valued at amortized cost, since they will eventually be realized at par at maturity. Marking to an arbitrary fair value over the life of the security introduces unnecessary variability on banks' results. However, on the flip side, in the shock to the system, such as a run on the bank where the bank loses the ability to hold these securities to maturity and must sell them immediately for cash at the then prevailing market value, large losses could ensue. Marking to fair value is thus an early warning sign that was absent on these held to maturity securities. Bank stress tests, which look through such held to maturity securities to stress bank balance sheets and liquidity ratios, were also missing in this case, as the banks failing recently were exempt from these stress tests due to being under the 250 billion asset threshold. In the current environment, as target interest rates have risen by 4.5% over the preceding 12 months, market values on loans made in the prior low interest rate environment have decreased significantly. But such decreases in market values were not reflected in banks' balance sheets because held to maturity securities are not marked to market. Such disconnect of the current market value of banks' portfolios versus amortized costs used under current accounting rules, coupled with not having to undergo stress tests, were two early warning signs that could have provided earlier detection of the recent problems in the banking industry.